Hey, what's up everyone, and welcome to episode number 23 of this educational video series. I'm your host Vijay and I'm a CPA. In today's video, we're going to review two of the most common accounting methods used by most small businesses while preparing their tax returns. These accounting methods are the cash method of accounting and the accrual method of accounting. We'll take a look at an overview of each method and also take a look at an example of each method, so that will kind of help to clarify how one method differs from the other. So without further delay, let's dive right into it. Alright, so let's start with an overview of the two accounting methods. Accounting methods in general determine when a small business reports their income or expense on their tax return. A small business first selects the accounting method they intend to use when they file their first tax return, and in most cases, if subsequently you decide to use a different accounting method for your small business, then you need to obtain an approval from the IRS. Most small businesses, as I mentioned before in the introduction, will be either using cash method of accounting or an accrual method of accounting. There are a couple other methods of accountings that small businesses or any business can use, but there are specifically for businesses obtaining in specific industries, or they sell specific type of products or services. They're very specialized, so we won't talk about those methods in this video. For now, we'll just focus on the two of the most commonly used accounting methods by most all businesses. In general, most small businesses are free to adopt either of the two accounting methods as long as they have annual sales of less than $5 million. However, a small business must use an accrual method of accounting if it has a sales of $5 million or more, or the business stocks inventory that it uses to resell to final consumer. So in that two instances, a business must use an accrual method of accounting. Now let's take a look at the cash method of accounting in particular. This is the simpler of the two accounting methods, and in cash method of accounting, income is reported when the cash is received and the expenses are recorded when the cash is paid out. So there are no accounts receivable or accounts payable accounts used in this particular accounting method. This method, since the cash is recorded as income or expense when it's received or paid out, it gives an accurate view of a business's cash flow for a given tax year. But because of the timing issues of when the cash is received or when the cash is paid out versus when the actual services or product was delivered or received, it does not portray a clear picture of business's income or expenses for a particular tax year. So it's good to know a business's cash flow for a tax year, but it's not ideal method for business's income or expenses for a given tax year. Now let's take a look at an example. Let's say a painter paints a home on December 23, 2015 and issues an invoice to the client on the same day. The painter gets paid on January 2nd of 2016, and since the payment was made since the cash was received in 2016, the painter will be recording the income on 2016 tax return, assuming he or she is on a calendar year basis. Now, same painter, in order to do the painting job, let's say buys supplies on December 23, 2015 and pays for that supplies on January 3rd, 2016. And since the expenses were paid in 2016, the painter will be recording the expenses on the 2016 tax return. So as you can see, the services were performed in 2015, supplies were bought in 2015, but since the cash was received or cash was paid in 2016, the painter will be including income and reporting expenses on 2016 tax return. Hope that makes sense. If not, just pause the video for a minute and read over the example. I think it's pretty clear as to when a business reports income and expenses under the cash method of accounting. Now, under the accrual method of accounting, revenue and expenses are generally recorded when they're earned. And earned meaning when the work is done according to the work is done, or the products or services are delivered to the final consumer according to the terms of the contract when the service contract or product contract was signed. This method does not take into consideration when the money is actually received or money is actually paid out. It's simply when the work is done and completed, that's when the income or expenses are recorded. So in this particular accounting method, there are accounts receivable and accounts payable accounts that are used to record the income and expenses that are incurred, but money for that income or monies for that income or expense items have been exchanged yet. This particular method gives a more clear idea of a business's income and expenses for a particular tax year, but it does not give a clear view of a business's cash flow for that particular tax year. This is in contrast with the cash method of accounting. Cash method of accounting gave a clear overview of the cash flow of a particular tax year, but not a clear picture of income or expenses for that particular tax year. Versus the accrual method of accounting gives a clear picture of a business's income or expenses for a particular tax year, but it does not give a clear picture of the cash flow, because accrual method of accounting does not consider when the money is actually exchanged for the products or services that are delivered. So let's take the same painter's example that we reviewed under the cash method of accounting. So let's say a painter paints a home. The work is finished on December 23, 2015. The invoice was sent to the client on the same day, and the payment was received on January 2nd of 2016. And in this case, since the work was performed in 2015, the painter will be reporting the income on the 2015 tax return, even though the cash was received in 2016. Now, in order to do the paint job, let's say the painter bought the supplies on December 23rd, 2015. The credit was received and the payment was made. Payment for the supplies was made on January 2, 2016. And since the products or services were exchanged in 2015, the painter will be reporting the expense on 2015 tax return. So I hope that makes sense to you all. If you have any question about this particular video or any other tax or accounting related topics, feel free to reach out to me. I'll be more than happy to assist you in any way I can. My contact information is on your screen. Now, final thing before I sign off, everyone, if you like this video, if you find the value in the videos that I create, please don't forget to hit that like button, share with your friends and family, and subscribe to my YouTube channel. Thank you all very much. I'll catch you all next time. Take care. Bye-bye.